Welcome back to Financial Intelligence, where we get to talk to important, smart people like Jon Syquimsian. Hi, John. How you doing?
Thanks, Ivito. Oh, Patrick.
Like I have pizza on my chin there. Yeah. So, John, it's been a while. How you been?
Very good. Over here at City National Bank in the business and commercial banking group, and very hopeful. I think last we spoke, there was a little bit of hesitation with the market, specifically with business owners, but I'm seeing much more. You could say cautious optimism, right? With recent news and events and some upcoming information and fingers crossed, more rate reductions by the Federal Reserve. So that's boding very well in terms of just overall, you know, um, thought process and enthusiasm from business owners.
Yeah. So you're expecting Feds to cut rates. How's that? I mean, how's that going to affect you on the business side? That's going to be better for you. Are you going to see rates actually lower? Because in mortgage, rates lower ahead of the announcement in anticipation, and then
Correct.
it kind of bumps up, and then it checks back up. So like we're back up to
And,
7%.
and for the most part, you're right. There is that behavior where the market will react in anticipation of whatever the Fed Reserve is going to, or FOMC is going to do. Um, the past meeting about a month ago was with the 50 basis point reduction. That obviously impacted the short term instruments that would impact HELOCs or lines of credit, variable rates, prime rate. So last we spoke, I think we were about 8.75% on the prime rate, and now we're at 8%. So November 6th and November 7th, the next meeting by the FOMC. Again, the anticipation by analysts and everyone out there is that another quarter basis point reduction will make those short-term instruments, right? That's the immediate impact there. The funny thing is, though, back in I think this past year, the lowest we hit, and I'm talking about specifically the 10-year Treasury rates, where we use that index quite a bit in commercial lending. Um, September actually was probably the lowest we've seen it in the past year, I would say. I think it got down to as low as about 3.63%. It did tick up though, right? I mean, despite
So
the Fed's reduction. Yeah.
your business rates went down to 3.6.
The treasury rate,
The
right, which
treasury,
is an
yeah,
index, right, of what
right.
we use. Let's say 10-year money, right? It, had did dip to about 3.63%,
Yep.
right? So lenders will apply a margin or a spread above that. Industry standard is somewhere around 2 to 2.5%. Um, Again, that's average industry standard. So around that time, you're probably looking around maybe low sixes or so. Today, the 10-year treasuries at 4.29%. And again, so you're probably somewhere low, if you're applying a 2% spread above that, you're around like, low sixes, right? In terms of your 10-year money or 10-year loans.
It's better than a credit card for sure, right?
Yeah, I mean, credit cards at 20 plus, percent
Yep.
has really been, a key, right? Indicator for a lot of businesses, right? And banks as they look at business owners. Like, the thing is, like I say, cautious optimism when I talk to businesses is that here's the conversation I've had the past year. Hey, business owner, you want to
Oh,
get additional capital to support your business?
oh,
Here's a line of credit, right, to support working capital. Business owner says, John, thanks. I'll take that, line of credit. To be honest, I'm not going to use it because the rates are so high, right? Just like a HELOC, right? I mean, HELOC rates have gone up. You might have it because you have equity in the house. Just use it there, but I'm not going to use it. I'm going to, I'll deal with that leaking roof for a little bit longer until the rates drop. So the same sentiments, right? I mean, just because they're businesses versus individuals, I mean, it's the same thought process, right? Like rates are going up, the cost of borrowing has been going up with all of those aggressive moves by the feds to curtail inflation. But now that has cooled, inflation that is, the feds are trying to ease back, right? Their target rate. Again, that bodes well because that cautious optimism by business owners, like, okay, now I'm looking to talk. Maybe now I'm going to look to expand the business, buy more equipment, really grow the business, right? And that bodes well for the economy in general, right? When the doors are somewhat open to borrowing and lending and moving those funds.
So if you're a small business owner, you want to become a small business owner, say you want to buy a dry cleaner or bowling alley or something.
Hmm.
Right now, just like what we're saying in the real estate industry is, yeah, rates suck right now. But they say marry the house, date the rate or whatever. I'm not a big fan of that because I think it's a bunch of hooey because you can't tell the future and you're betting on the future. But what we're telling people is, look, I know it sucks right now. You could buy down a loan. You can buy it down to 5.5%. And by the way, that's our parity right now. That's where our projected parity is. So that means it becomes where buyers now come back into the market, and sellers say, well, that 2.5% is great, but this isn't my forever house. I think I'll move to the forever house I want. So I can afford to buy a 5.5% loan versus a 2.5% loan, where where we're stuck right now is like 7%. But we're telling people we can buy down the loan. So you put a couple grand into the loan. So if it's $1 million loan, you put $10,000 in, and then you drop the percentage, your APR, down a little bit. So that's one tool that we're working with on the real estate side. I don't know if you have that. Is that something where you can say, I'll give you extra points, buy the points down?
Not necessarily. I mean, if you want to, so for us, right? If we're looking at, let's say, commercial real estate, um, and we have termed debt, right? Fixed rate loans. We have to lock in that rate, right? We go out into the market. Let's say take the 10-year Treasury and lock it in for you. We would, as a lender for commercial loans, almost always apply a prepayment penalty, right? Unlike resi loans, where you can restructure, refinance, pay off, or those debts, there is somewhat of a restriction, if you will, on commercial loans, right? With those prepayment penalties, and some of those, because there are different types of prepayment penalty languages, can be pretty onerous. And not to go too in depth, but there are the simplest ones where it's like a 5, 4, 3, 2, 1, what we call a declining or sliding prepayment penalty. After the fifth year, there's no more. You can pay it off. But let's say the first year you want to pay off a loan, it'll be 5% of the outstanding balance.
Oof.
So that can be
Okay.
pretty hefty, right?
Is that an industry standard?
Yes, pretty much. Now, some lenders will allow you to pay a premium to get much more flexible
Yep.
prepayment, structure, right? You want to do a 3-year pay down, that's fine. It'll be 5.31%, right? For those 3 years. And some, if you want to, but not all, wants to pay off or have no or waive the prepayment penalty. You could, but it comes at a very hefty cost, right, up front. But
Yeah.
it's rare that I've seen those.
It,
John,
it makes sense because 20
Mhm.
years ago, 30 years ago, they had prepayment penalties. It was a standard,
It's
and it was expected because, as a matter of fact, I know lenders. We've had Hector on this show where he helps somebody buy a house, and even though there's no prepay penalty, the new owners turn around within a month, refinance the house with another lender, and he loses his commission, the fees on that. So there
Hmm.
is like a 6 month bump. You have to wait 6 months before you turn it off and then refinance. But it's just part of the game that people play, right? So, but
Yeah, and
if I buy a 7% loan and then I can turn around and go to 5.5, I'm going to do it.
yeah, I mean, as a
Yeah.
consumer, right, as a business owner, whoever's borrowing the money, it makes more sense. I'm the first one to say, go for it. If you can get money at a lower cost, by all means, go for it. However, lenders, especially in commercial lending, are attuned to that, so they try to indemnify themselves of that loss or potential loss. Because if we lock in, let's say in the market, and it's showing a 7% rate on that loan that we committed to a business owner, right, for a business loan, and then they pay it off before it comes due or matures, early prepayment, and we take that same loan, repackage it, and go back out into a market, but it's a more depressed or a lower rate market, where we're going to eat that loss, right?
Right.
So let's say it was locked in at 7%, we repackage it, and now it's a 4%. There's a 3% variance, right? We're going to eat that as a lender. So to indemnify, like I said, or mitigate that loss, prepayment penalty structures are put in place,
Yep.
right?
I
To
mean,
break
you
us
got
even from that.
you're, you're a business, right? Your business is money, and I get that. It's part. It's the reason why so many banks this last year went out of business is because rates went
Hmm.
up and they couldn't service those loans because there was just no takers on investing in those loans, those
Correct.
billions of dollars of loans. So that's why Silicon Valley Bank, for example, that was exactly the problem. The rates went up and they couldn't service those loans anymore. The investors pulled out, and they're so it's a kind of a catch 22, right?
Yeah,
Of
definitely.
course, of course, Uncle Sam bailed them out, so I guess they're
There
okay.
you go, John. So that's like how it were. I think what you just laid out was what the commercial lending looks like, and but you also said a business owner or somebody who wants to start a business. What's the difference between that and then securing a line of credit? I wouldn't imagine there's a
Mhm.
prepaid penalty on the line of credit. And is that something they could do?
Correct. Correct. That's a good question because so to answer your question, Patrick, the prepayment penalty structures, right, are apply really to fixed rate loans, right? So a lender is going to commit to a fixed rate. If and the challenge for the lender is, or the exposure to the lender is, the fluctuation in the market, right? So if that loan that's fixed rate gets paid early and the market is depressed, and the rates are lower, that's where the prepayment penalty kicks in because it helps offset the loss, the potential
Sure.
loss to the lender.
It's
Variable rate, right? Like your short-term instruments, lines of credit, credit cards, things of that sort. Usually, I tie to indexes like the prime rate, or the it used to be LIBOR, but now we use what we call SOFR,
Mm.
SOFR,
yeah,
um,
he's the king.
as a variable rate. Yeah, yeah, the secured overnight financing rate. I mean, that's currently at 4.9%, right? So and it's variable, right? So that's the latest and greatest that many business and commercial lenders use. And prime rate is at 8% right now.
So I guess I'm trying to figure out. 'Cause it seems to me the line of credit would be the way to go, right? Because
Um, it
I,
depends. Yeah.
I mean, obviously, it all comes down to the scenario. But all things being equal, I would think the line of credit I can reuse again as I need it, as I pay it down, so the payment goes down. Sure,
Hmm.
the rate is variable. However, cash flow is what matters. I would imagine. In the fixed payment route, it's great to get a fixed rate, but my payment will always be there. There's a prepay. It just seems like there's less flexibility. So I'm guessing, and you correct me if I'm wrong here, obviously, the underwriting to qualify is probably, you got to be a little bit more established and have a little something more going on to get the line of credit versus the fixed rate. Or how does that work? How do you differentiate? If I'm a new business owner, or I want to own a business, I want to
Hmm.
own. I think Vito gave the example of a dry cleaning place or a
Hmm.
clothes washing establishment or whatever it may be, right? Some kind of small
Bowling
business.
alley, I said.
Bowling
Mini putt.
alley, yes. Bowling alley.
Bocce ball court. Yeah.
Can't put a
A
bocce.
house of ill repute, whatever it might be. What
You're
my
so
options
funny.
there?
So if you want to start a business, right? I mean, I think there's there's two types of lending. If I could break it down easier, there is conventional lending, which is straight through the bank, right? We're not going to put it out at the secondary market. We're going to be a portfolio lender, and we as the lender have a vested interest to making sure you as the borrower can satisfy the loan and meet the debt obligations. So we're kind of neck and neck holding that. That would require, in terms of underwriting, some minimum guidelines. Most lenders would look at least 2 years time in business. Um, and of course, there's underwriting because they want to look at historical cash flow. Most business and commercial lenders out there are what they call historical cash flow lenders. You want to see filed tax returns. You want to see what your EBITDA is, right? To be able to satisfy the proposed debt, whether it's a line of credit, or a commercial real estate loan, right? A fixed rate loan. Now, kind of going back to what you said, Patrick, what's the difference? Rate aside, we in lending, especially following certain regulatory, compliance issues, right? And meaning trying to meet gap requirements, right? Like a general accounting and
Generally
principles,
yeah.
accepted accounting principles. I forgot the accepted part,
Yep.
but want to align the lending solution, the loan solution, right? The debt, if you will, to uh, the use, right? The proceeds. So general rule of thumb that I would tell business owners is lines of credit, right? Variable rate. Right now the rates are dropping. That's great. But if you want to look at it in the sense of if you can pay off any debt on the line of credit or utilization within a 12-month period, and 12 months by gap standards is current, then that would constitute a short-term line of credit or short-term financing need.
Mm.
If you are a business owner and say, hey, you know what, I want a line of credit, but I probably won't be able to pay it. You know, let's say I use the entire line of credit, but I can't pay it within 12 months, and it's going to go beyond that. We're really now talking more instead of short-term financing. That's more like permanent financing, especially in the purview of gap, right? Anything over 12 months is no longer current. It's going to be much more of a long-term debt, right?
But that would
So,
have to be a
or
capital debt,
liability.
right? That would have to be more like an equipment capital debt instead, because what
Correct.
you're financing on line of credit is cash flow, or I just need an
Just
extra
short-term.
$30,000 to pay off my payroll this month.
Yeah. So those things, those ongoing expenses, right, to keep the business operating, right? So anything within a 12-month period, just your
Right.
day-to-day stuff that you might need, short-term working capital lines. Now, larger fixed assets, real estate, equipment, vehicles, anything with expansion, you want to buy another business or even a partner buyout. Yeah, those would be fixed rate debt, right? So because that's permanent financing. And you want to, again, in this market, y- that's going down in terms of rates, or at least anticipated reduction in rates, not an issue. But oftentimes when you're a variable rate, you don't want to expose yourself, right, to the fluctuation in that, right? So you want to fix it.
So you have credit card, which is high interest, short term, super short, like hopefully monthly
Hmm.
payoff. Then you have your line of credit, which is up to 12 months for cash flow. A big order comes in, you don't have to worry about
Hmm.
paying off for vendors. And then anything over 12 months is more capital expenditure or scaling.
Correct.
Okay. And then obviously the longer the period, the smaller the interest rate, but we're still looking at 8 minimum, right? 8, 7, 6 minimum.
It depends. I mean, if we're looking at 10-year money or 5-year money, we just go off typically the treasury, right? The constant maturity treasury rates, CMT rates. So
Or
again,
so
the 10-year is at about 4.28, 4.29 right now.
the SOFR king.
The SOFR.
So comparing and contrast, because I'm a real estate guy. I'm a real estate
Mhm.
residential real estate guy. There's no Fannie Mae guidelines. There's no Freddie Mac guidelines. Is it just the gap guidelines that you're comparing them to, or is it something else? Is it whatever the bank creates, that whatever the institution creates says, these are my guidelines for investors to say, this is the kind of risk that I want to buy?
No, it varies because I mean it also varies in the type of building. I mean, if you're looking at your standard flex space, industrial R&D kind of stuff, that's very vanilla. We just want to make sure that again, gap is one thing when you look at for underwriting, but not necessarily on the compliance standpoint.
But there's
If you're
no
looking at
like
mixed use,
federal guidelines like Fannie Mae or Freddie Mac.
well, I mean, there's certain things that we look at. Let's say mixed use, right? That's kind of something that's considered. If the definition of commercial or what would go to commercial is any units above four, right? So if I am looking at an apartment complex or multifamily that's about 7, 10 units, that would fall for the most part with lenders into their commercial or business banking group, right? 1 to 4, that's all resi.
Right.
So
So
some
anything
of
after
those
that, you have
would still
to.
apply, but some of those would still apply, right? Like, you know, I mean, we have all of the regulations. Sometimes one too many that I can remember, right? They get your Fannie Mae's. You got like there's a bunch of obviously HMDA stuff. I mean, they still apply, right? But on the commercial side, if I'm looking at specifically underwriting, when we're looking at let's say mixed use or investment properties, um, that's actually relatively easy to be honest. We just underwrite to the property itself being able to generate net operating income, right? Minus whatever vacancy rates that they would apply. And lenders have different ways of applying that.
But you add value to how much rent you're coming into and how much you've improved the property, that kind of stuff. It's a totally different.
Correct. I mean, yeah, we'll run appraisals and all that, like just like anything else, right?
Yeah.
But we want to see that the property itself, and again, I'm strictly talking about investment property, based on rent rolls, can service the annualized debt that we're proposing on this loan.
Not the
Another
pro
question.
forma. Go ahead. I'm sorry, Patrick.
No, this is all great stuff. Another question in this vein. So, say you're like a LLC or something like that. You're in a partnership,
Hmm.
and you're accumulating property under that LLC. And would you be able to secure a commercial line of credit just to have out there open in case you need it? Is the underwriting the same, or the threshold to qualify for that kind of similar? Could you do that? And I guess I'm trying to think, why would you want to, as opposed to holding it personally? But I would think, commercially under the LLC be the way to go. What's that look like?
Yeah. Um,
Vito had his hand
one
up. I think
is
he
you
knows the
want to
answer to
just
the question.
I'll let John
you want to
speak.
separate it, right? I mean,
I know the
if
answer.
there's a reason why. Yeah, there's a reason why you incorporate or form an LLC, especially for that particular asset or building or property. Just to offset your liability, right? Personally.
Right.
Then there's so many different factors to that. Again, I'm not a CPA, full disclosure, not accountant, but there are also certain tax benefits, right? If you're going through what they call pass-through entities like LLCs or S corps. So to your question, Patrick, when we're looking at lines of credit or short-term working capital financing, lenders want to know what the purpose is. So oftentimes I get requests from, let's say, retail, right? Businesses. And they say, hey, I want a line of credit. The challenge there, right, in an underwriting standpoint, now I'm putting on my underwriter hat, if you will, is that like, hey,
But
this
full
business,
disclosure, you're not an
retail,
underwriter either. right?
Yes, that's right. That's right. That's right. No, no, I see daylight. I think some of those underwriters don't have windows in their offices. But no disrespect to any underwriters that worked with out there. They're great. I just wanted you guys to keep approving my loans.
There you know exactly who's in charge, right?
Yeah, just so it's clear.
Exactly.
Yeah.
So, underwriters say, hey, what's the purpose? Because it's really for short-term working capital needs, specifically if you are, let's say, on an accrual basis, right, of accounting and collection. It's really, and you have accounts receivables, you're setting different terms, and then there's a cash flow gap, right? That's creating a need for that line of credit. Now, if you're retail, right, and you're selling clothes and you're just getting paid cash, it's all COD, cash
Yeah.
on delivery. It doesn't create a cash gap, if you will, or working capital need because you're getting cash right away, you're getting revenue, and you're just paying your vendors right away. There aren't any terms to create that, right? That's the general underwriting thought process on that. Now, there are LLCs. I do have clients that have properties and they say, look, I just want to have a line of credit or just additional capital in the event my roof
Right.
caves in or knock on wood, something happens and it would be for maintenance or whatever capex related to the business or the property would be. If you have enough equity, just like a HELOC, we could, right? Most lenders can't put in place like a business equity line, right? That's tied to it, dependent on what equity or value you have on that property. So that's a different thing than an operating capital line of credit.
And there'd be no prepaid penalty, right? It's variable rate, but it can stay there open for as long as as long as the business is operating. There's no like annual underwriting renewal or anything like that, or how does that? Like, when does
It
it expire?
depends.
You have to requalify for the line.
It varies per lender. Generally speaking, most lenders will have a 12-month or annual renewable line of credit. So after 12 months, you have to provide updated financials just to make sure the business and the operations are still going as it was 12 months earlier to just renew the line. Some lenders will what they call put an evergreen clause on some of their lines of credit, right? If it's a smaller exposure to the bank or lender, let's say 250,000, or some maybe do it $500,000 or less, then they can make it an evergreen line of credit, meaning that there isn't a maturity on it. As long as you're satisfying payments, you're not late and such, then you're fine. No maturity. Now, that said, from time to time, even though it's an evergreen line of credit, the lenders might still want to, as a monitoring covenant, right, or condition, to see some of the financials, right? Oh, hey, provide us your P&L, provide us your income statement every 12 months or every year. It really depends. It also depends on the industry. I mean, I work with a lot of contractor businesses, and the nature of their billing, because it's progressive billing, it's milestones, and you got to really monitor that. I look at it like on the monthly monitoring, right? I'm looking at their profit and loss and income statements every month. I'm looking at their accounts receivables every month, their inventory reports, their WIP or work in progress every month. So it's really tight monitoring, but that's just the nature of their business.
But it's also the nature of how you lend that money out to them. They have to have those milestones in
True.
order to get the next bastion of money.
Tranche of, yeah, exactly.
So one thing I want to hit you over the head on, and I know there's no perfect answer, and you're not the reason why you're getting hit over the head. You're the messenger. If you start a business and you want to create an LLC, that LLC has to be around for 2 years to show finances in order for that LLC to borrow money. Otherwise, you have to personally guarantee that loan. It makes it hard for small businesses.
Yeah, it'll be hard. I mean, generally speaking, most lenders will require, especially privately held businesses, will require what they call full recourse, personal guarantees. SBA, which is a great vehicle for businesses looking to get financing. They sometimes they do acquisition financing, business acquisition, and like startups. You want to buy, I guess to use your point, like a dry cleaning business.
Car wash.
Um,
Yeah.
the SBA 7A loan program will do that, but SBA will require personal guarantees.
Hmm.
The only time I don't see personal guarantees in lending, in business or commercial lending, is much larger, right? Businesses. I mean, if you have an Apple public company
Well, they're
or
established,
a
right? They already,
business, yeah,
right.
or even a highly diluted, right? Business that general rule of thumb, 20-25% ownership or more would require personal guarantees. If it's maybe 20 plus different owners with just maybe a small percentage, like 7% here, 6% ownership here, it's really hard, right? I mean, you're trying to perfect and secure liens on an individual that has very minor shareholding or ownership at a business. Yeah, it's hard, right?
Right.
So again, most lenders will require full recourse, personal guarantees, but it really is case by case.
And a lot of this, it just reminds me of I think we talked about this before, how important it is to just develop a great relationship with your neighborhood, you know, commercial lender and banker, or
Spider-Man.
create a relationship there. Yeah. Right. Because things change, and having somebody you can go to answer these questions, walk through your scenario, somebody who knows the underwriting
Right.
process, knows, yeah, there you go, knows how the
That's why we're
underwriting's
talking to John. Doink, doink, doink.
Yeah.
Yeah,
It's
and
just,
and a good, I mean, not to say, yeah, a good bank or lender is going to always be an advocate, but also tell you, just like anything, right? You want to have a good friend on your side that will tell you the good, bad, and ugly, right?
right.
So as I have businesses that I've known for what 11 years or 12 years that I'm helping one out right now that, let's just put it this way, is disillusioned by their incumbent or existing bank. I've known them for a while, and they reached out to me, and I said, "Look, this is the reason why the current bank is giving you some heartburn, but I've known you for a while. Let's address it, right? Some of your numbers might have changed, but if you're as a banker, I'm a seasoned one who knows the market a little bit. And plus has a little bit of OCD. I'm able to help. I was able to help them out, right? Because I'm like, look, I know your
Right.
business is this. It's tied to supply. You're reliant on supply chain because you're an import exporter. A couple of years ago, we had a big issue with supply chain.
Yeah.
Um, you know, but that was actually a good thing for import exporters because again, it all comes down to the sentiment, right, or behaviors of folks out there. Supply chain issues, things getting stuck in the ports. So this particular business's clients went nuts and started ordering more than they usually do. So it's a banner year, right? What is this, 2022? And 2023 comes in and it's slowed down. So it looks like a huge decline in revenue. But again, if as a banker and you're being a true advocate, you got to really, and you have that open line of communication, right, with your banker or lender. Um, they can tell the story because an underwriter just looks at numbers, right? They're just going to see
Right.
this. They're not going to see the true picture. So it's
Right.
incumbent on
Right.
me to say, hey, look, you're seeing this, but there's a reason why. If you take a sample of this 11-year business, and this is that one blip in 2022, what are they going to say? No to clients who are ordering 35% more than they usually do? That's still revenue, right? It just eased up back to normal in 2023. But if you look at 2021, 2020, 2019, COVID years, it's still the same, right? They were still chugging along the same way. So
Yeah.
where that existing bank didn't do justice, I guess you could say, to that business, I was able to because again, I had the fortune of knowing them longer, and I knew their business pretty well.
See,
That's
it's
awesome.
always good
I
to
was just
pick up
tooting my own
pieces
horn
where
there.
other people fall, right? So let me ask
Yeah.
you,
Yeah,
let's say, yeah, out of you and the man. Um, let's take a car wash, for example. And let's say I have an opportunity to buy a car wash. And let's say it's
Mm-hmm.
$500,000. And let's say that I'm worth, I don't know, $1 million, 5 million, it doesn't matter, right? But I don't want to use my
Mm-hmm.
money. How can I get a hold of that car wash without seller financing? I know that's always an option, but how
Mm-hmm.
can I use the institutions to do that? Or is that even possible? Or
Conventionally, it would be tough, right? Because we don't necessarily finance uh, conventionally goodwill, right? Like you're technically buying goodwill. You're buying a business, but it's hard to evaluate that. And we
Even
look at historical.
John, I'm
Mhm.
curious. Even
Yeah.
in a situation where a business has been existing for say it's a 30-year-old car wash, has 30-year
Hmm. Hmm.
receipts, right? It's in a location that's cash. We know it's cash flowing. It's getting a new owner, because essentially
Hmm.
you're saying, yeah, that's all good and fair, but we're underwriting the new owner, not necessarily the business.
Both. So we're underwriting to the historical. So we're going to look at the seller's financials
Hmm.
to see historical performance, and then we're going to look at the new owner. So the quick answer to that, conventionally, no. But I mentioned before, there's two types. There's also SBA. So SBA is a good avenue for that, right? Specifically the 7A loan program.
but there's a down
So
payment requirement.
there is a down payment requirement. SBA 7A also has what they call our SOP, or standard operating procedures, or their guidelines, where if identified, the lender, right? Because again, it's still the bank or the lender that's going to extend the credit. SBA comes in as a guarantee, right? Almost like insurance. Like, hey, if anything happens to this loan, City National Bank, we will cover up to 90%, right, of that.
Right.
So
It's like
it
an
helps
FHA
us.
or a VA. The FHA
Correct.
guarantees that loan, but the institution actually funds the loan.
Still funds it, right? Yeah, it's still their proceeds. Yeah, correct.
Right.
So SBA would be a good option for that, where they look at still the seller's, um, financials, because they want to see historical performance, and then they will still factor in the new owner, right? I'll give a quick example. I've been helping out a franchise, which is an after-school daycare program. They have probably now close to about 35 locations. My client's the franchisor, and he's been introducing me to the franchisees, right? So he's like, hey, I've got husband and wife interested in buying into this. We look at the performance of the franchisor and all of its different franchisees.
Hmm.
And under the 7A, right, SBA 7A loan program for business acquisition, we were able to put some stuff through, right? Because what helps is if you're, let's say, husband and wife, which, a lot of these small businesses are going to probably be managed. Um, you have one of the partners, whether it's the husband or the wife, still generating external income, right, from whatever job that they may have. Because again, we look at it not just on the business aspect of it, making revenue to support the loan. We also look, again, full recourse, personal guarantee, as a secondary source of repayment on the guarantors, right, the individuals. So if, for example, I believe it was the wife who was working at a tech company, made some good income, we consider that, like, hey, knock on wood, there's another source of repayment. If should, knock on wood, anything ever happened with that first one, the business. So we look at different factors, right? We call that global cash flow or global debt servicing.
So with that, you would it's kind of like starting your own business, having a side hustle. For example, I do real estate, and if I bought this, I want to say gas station, this car wash, and I put some of my own money down, got this SBA loan, it's still personally guaranteed. It's not completely divested from me from an LLC. I'll still want to have an LLC or the title
You
held
would.
under the LLC for liability, for legal liability. And there's also tax reasons why too, but I'm still attached to that LLC or that asset, that loan personally.
Correct.
until I'm
How
there
do you
for
get out of
2
that?
years and I prove that I'm a decent
Mhm.
businessman, then I can refinance and then
Got it.
get myself off it completely.
Yeah, and that's the thing is a lot of clients like I want to get out of personal guaranteeing or in the case of SBA 7As, I was alluding to that earlier, but I don't think I kind of went into detail. Identifying, okay, you have property, they would put, let's say, a second, or let's say you have equity in your residence. They want to get additional collateral, right, to support that. Because again, buying and starting a business, it's all goodwill. It's hard to do the valuation they want to do per SBA guidelines, additional collateral to support or secure the loan. Even though they are guaranteeing it, they seek that. It's literally written out on the SOP or their guidelines.
Got it.
Just from like
Well,
my personal scenario, it would just be easier for me to get a HELOC and fund that. And then later on, after
Oftentimes,
2 years, I
yeah,
can go to you and get a long-term loan.
yeah. Once you get into that 2 years lending, that's fine. Now, I think I mentioned before when I was talking to you separately, Vito, there are other lenders out there, but again, I think 2 years is the general standard in the industry in terms of time in business. But there's something called CDFIs, which is Community Development Financial Institution or institutions, right?
Is that
They are
private?
also lenders.
Is that muni run or is that institutional?
Um, a lot of them are nonprofits, right? So, and some of them could be banks, like community banks and such, right? So it's basically uh, a group of lenders that might have much more lenient, you could say, underwriting guidelines. They specialize in, I mean, some specialize in agricultural lending, right? I mean, that's hard to touch for some conventional lenders. So, there's a big list. And then if you look under CDFI um, fund, I think it's cdfifund.gov. They'll show you a list of these lenders that go into that. So, where let's say a debt service between your net income as a business to the annualized debt, right? Principal, interest, or whatever you want to calculate it as, would be a ratio of 1.25 or 1.5 to 1, meaning that for every dollar you borrow, you have at least net income of $1.50 or $1.25, right, to cover it. Uh, some CDFIs, these lenders, might lax that to maybe a 1-to-1 ratio or 1.15,
Right.
very similar to the SBA
I don't think I've
standards.
ever heard
So
of those before. That's pretty interesting.
there's quite a few of them out there. There's one that, funny enough, I actually got into banking because of a CDFI lender, one called Axion Opportunity Fund, right off of here near San Pedro on West St. Or St. John's.
Didn't they sponsor the
They
Sharks for a
do.
bit?
They may have. They may have. I should have gotten tickets anyway.
Uh,
Did you work
Hey,
for
I
them
gotta
or
start.
did you
No,
invest
I
in?
didn't. So how that came about, as Vito may know, I was a chef. All right, that's what brought me over here,
Right,
and
right.
Quite the leap of
my
trust.
yeah, my mother-in-law actually introduced me to this nonprofit. Right, it was partnered up with Catholic Charities over here in San Jose. So what they did is they say, listen, you as an individual wants to learn how to save money for a life goal. Mine was okay. I want to pay tuition to get my my BS in business management. All right. Uh, so I was going to school. I put $1 in, save it, and then this organization, with the help of Opportunity Fund and Catholic Charities, would match it 2-to-1. So in a way, it's kind of like free money, right, to help me pay and go through school. But that was just one component. They also do micro lending for businesses, small businesses. They even had a niche of, a few years back, maybe 10 years or so, uh, food trucks were the big thing, right? There was just an emergence of food trucks out there. And they had a specialty in helping finance a startup business for that. So um, I took the courses. I ended up working through that, and then as I graduated, I actually got a call from the bank that was managing that relationship. They took a fiduciary role managing those accounts, and they tapped me and said, "Hey, have you thought about banking?" I was like, "No, I don't even know what. Is there a person behind that ATM machine? I don't know what goes on, right?" So I have no clue anything about banking. But
Dude, how long have I
um,
known? How long have you been doing this? I still have no idea what banking is. I had an uncle who did the same thing. I
that's
still
right.
have
That's
no idea.
right.
I thought there was a midget inside that machine that kind of
Yeah,
did all the counting.
yeah.
Watch
No
it,
offense to
Frederick.
midgets.
No.
I still don't know. Maybe yeah. That's you never know. So so yeah. So anyway, I ended up working at that bank. They brought me in as a junior business banker, and I just the irony of it all I ended up becoming the account manager for that nonprofit organization,
Oh, that's cool.
which is now a nationwide CDFI, and they're very active out there in the community.
And what I do is
So
show this on.
oftentimes, banks like myself are very conventional. We have certain, sometimes you could say, strict underwriting guidelines. Might not be able to accommodate a request. I immediately introduce them to one of these CDFI lenders and say, hey, you know what? Talk to these folks. They may have a program for you. Now they all vary. There's like hundreds of these all over the country.
Sure. Wow, that might be something to look at a little bit more too. John, I gotta get out of here to
Mhm.
go pick up a 3-in-1.
No worries.
Be super hungry, so I gotta get the snacks together. As you guys probably remember how all that goes.
Yeah, avoid the hangry. Yeah, you want to avoid the hangry.
I was
That's the real
on
deal.
my throat before 2 o'clock. I was like, ah.
Ah.
Now I'm like still trying to stay awake.
Hey, but the next 12 months should be super interesting with the new administration, whatever administration is going to be, and the economy doing different things. So we'll see. It's going to be interesting times. So it'll be good to check back in with you. And I think there's a lot of stuff we can
Looking
put
forward
out
to
there
it, always.
that people
Let's do this
check
again
out.
same time next week, or not next week, but 2 weeks from now.
I'm good. I'm good
All right,
every other
that works for
week.
me.
All right, cool.
Yeah,
November
ditto.
1st today. Happy 1st. So I guess the 14th, 15th, whatever.
Yeah.
Right before Thanksgiving.
Sounds good. Happy freaking Thanksgiving.
All
right,
right,
guys.
everyone. Take care.
Okay. Bye.
Thanks.